please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
For the markets, it's still mildly in the green, but it's very, very choppy, you'd have to say. The mid-cap index especially has now moved into the red. It's down about 65 odd points. Good time to get you an update on what's been happening in the commodities market this morning. Manisha Gupta is here with a quick check on all of that. Hi, Manisha.
Morning, Sonia. Thank you so much for that. Well, we are looking at a green across commodities in this sector as well. The weakness in US dollar as the US Fed continues to stay pat on 3 interest rate hikes in 2018 is something that has taken the surprise or the bullish element out in sense of US dollar there. So nearly with 7/10% of decline for the dollar, we have seen strength continuing for the commodities there. The crude oil prices, they gained nearly 2% overnight, and we are around 4250 in the Indian crude prices there. Flat, as much of those gains actually have been factored in the overnight session itself. But apart from that, it is about the US weekly inventories. Those have shown a decline. You also have seen OPEC compliance come in at almost 140%. There are Saudi Arabia and Iran tensions surfacing yet again. So everywhere that you look, whether it's currency, supplies, geopolitics, finances, all of that really has been supportive for the crude oil prices, which have gained 10% from their March lows itself. It's a similar strength that you have seen come back for the gold and silver prices also. Off those 3-week lows in the gold prices, from almost breaking below 30,000 in the Indian markets, we are back around 30,500 for this one. Yet another quarter percent gains coming in here, and we have seen nearly 3% gains come in for both of these commodities for this week now. Similar story for the metal space also, where you have seen a big jump up come in the LME and the Shanghai markets, and exactly what we are mirroring in the Indian space as well. The only concern here is about the Trump administration, giving out import tariffs on China, and that is something that could really take some of these gains out of those prices before this weekend. But at this point in time, 0.5% to a percentage point gains coming in on your screens, not just for the non-ferrous metals, but ferrous metals as well. So you have the steel and the iron ore prices trading in positive as well today. But trading strategies, we have them from Angel Commodities, and it's a buy call as expected. In case of the crude oil prices, they're looking at targets of 4,300. They also have a buy in case of gold prices with 3,650 onto that one.
All right, Manisha. Thank you very much for those commodity strategies. And a roundup of the early moves. The market, in stock markets at this point in time, still holding on to most of the gains, but finding resistance at the 10,200 mark. Mid-caps have lost a little more, so the advanced declines are slightly in favor of decliners. Otherwise, it's a green picture. We're taking a break and coming back with the big CNBC TV exclusive. Market still steady state as far as the Sensex and the Nifty are concerned, holding on to the 1/3 of a percentage point in terms of gains. Gives us time to listen to what I would consider a very interesting conversation, our CNBC TV exclusive. I caught up with Neelkanth Mishra, the equity strategist at Credit Suisse, from the sidelines of their conference in Hong Kong. I began by asking him is the current state of the banking system going to make growth hard to come by? Listen in.
What has happened over the past 5-6 weeks has been quite worrying. So what has happened is that the NPA recognition issue has been changed. So all the alphabet soup of S4A, SDR, etc. has been replaced with just IBC. What this does is it brings forward a lot of the loss recognition. So this erodes capital for the banking system. The bond yield increases that we have seen have also eroded capital for the banking system. In addition, the change that 50 crore and above NPAs can be investigated for fraud means that there can be significant reluctance among the bankers, especially the PSU banks, to issue new loans. Now, if 2/3 of your banking system is reluctant to issue new loans, then there is no way that the economy can accelerate. Plus, the concern is that the bond yields have stayed higher for too long, and that the longer they stay at these elevated levels, the more the drag on the economy. There are a couple of other concerns. The first is that the aggregate government spending growth is likely to slow down from about 14% in FY18 to about 10% in FY19. The second concern is that there is at least perceived change in the possible outcomes of the next general elections. And as that political uncertainty picks up, as the state elections play out in the rest of the year, I think that can also create some overhang on the market. This is in addition to all the distortions that we have been observing, that the agricultural income growth is weak, so nearly half the economy cannot consume, that the private sector investment cycle is not picking up. Well, it's picking up in pockets, but not a very broad-based recovery. And lastly, in the last 2 months, we've become very concerned about the rupee being among the weakest currencies in the world, and possibly this weakness could last.
Okay. Well, much in what you say, but just a little earlier, we interviewed Uday Kotak, and his point is that the non-PSU bankings and NBFC space has got enough money and the clout to lend as well. Separately, we've been picking up from, say, Bharat Forge and L&T, all those road guys, that actually the order cycle is picking up. So you don't think that there are enough growth drivers to counter the negatives you're speaking?
Okay, let's put the current growth numbers in perspective. So there is, now December quarter growth was 7.2%. The 25-year CAGR growth in India, GDP growth, is 7%.
Okay.
The 5-year CAGR is also something similar. So 7.2% is actually not very exciting growth. Now what we are saying is not that we see a growth collapse, right? But what we are saying is that the consensus view that growth continues on its upward momentum, that it accelerates from here to 7 to 7.5% is unlikely to happen. So very likely the peak in GDP growth or the growth acceleration is now already behind us. It is wrong to expect that we will expect that we can see stronger GDP growth in FY19 than we are seeing right now. So I fully agree that I think the private sector banks and the non-banking finance companies will benefit. So that is why in our recent model portfolio changes, we had gone neutral weight on private banks in October last year, when we thought that PSU banks would have growth capital and therefore margins would come down. But now we have partly reversed that trade. We have now again gone overweight on private banks because they're going to benefit from this lull. But remember that there is a decision-making freeze. This is not just about activities, or rather it's not just about availability of capital. It is also about the willingness to take decisions, and the fact that earlier, if you ask anyone, I mean, see, if all the problem loans are beyond 6 months going to get thrown into the insolvency procedures, I think that is a bit too harsh, because there can be wrong business cycle decisions, and that kind of reluctance, it's very hard to offset by just saying, okay, now capital is available.
Neelkanth, I'll come back to you on your model portfolio, but first on the general investor sentiment. India has relatively underperformed since the beginning of 2018. What are you picking up when you talk to your clients at the conference? Is growth going to be a concern? Is valuation a concern? Because on ground we do get a feedback that maybe Q4 earnings are going to be much better than what the street is expecting. So what's your call there?
Yeah, so the sentiment by and large here seems to be quite cautious on India, that there's something wrong. See, that is the issue, right? So the currency is looking a bit wobbly. The bond yields have spiked. The term premium, if you were an observer, and I've stated this now for the last several months, if you were an observer of the Indian economy, and if the bond yield and the term premium was the only thing you were looking at, you would say that there is a crisis brewing in the economy, that there is something seriously wrong. And I don't think there is anything seriously wrong. I mean, there are growth impediments, there are headwinds that have emerged, but the point is, but if you were doing that, if you're looking at the bond yield, then you say, my God, there must be something wrong. Now, there has to be some response, there has to be some way that this unintended monetary tightening is reversed. So yeah, so the mood here is cautious. There are concerns emerging on, and all the news flow around the political developments, the concerns around the fact that there is uncertainty on how banking system profitability may emerge over the next 12 months. All of these are issues that people are grappling with. So you're absolutely right. The coincident indicators. So the current, say, consumption indicator, like say airline traffic or car sales or durable sales, many of these, and these companies are also reporting recent numbers. They look good, but these are in a way coincident to lagging indicators. What is forward-looking is actually showing some signs of concern.
Okay. Just to continue with what Nimesh is asking, therefore for the next 12 to 18 months, you're not just expecting a fall in multiples, but also a fall in earnings? Or rather a slower earnings growth?
See, the P multiple premium that MSCI India enjoys over MSCI World is about 17% right now. Slightly at the higher end of the band it has been in the last 8 years, but it's not really out of band or egregiously expensive. So you can spin an argument about a 5% drop in the P multiple to make it, the average of the last 8 years, but I mean, it's neither here or there.
Okay.
On the earnings, what has been remarkable in the September and December quarters is that we've not seen any cuts in, not meaningful cuts in FY 18 and 19 earnings. And as a result, as we move forward, as we rolled forward 6 months, the 1 year forward EPS for Nifty and the BSE 100 is already up 10% in the last 6 months. And I suspect, so if the banking system NPA issue does not really lead to a sharp change in, or sharp cut in earnings in the March quarter and the June quarter, it is quite possible that this roll forward benefit continues to happen. So I'm not, I would hate to be very bearish on the market. I mean, unless the global markets really tank or some really serious volatility comes because of this trade war. One of the key issues that is being discussed here, and I'm sure in media all over the world, is a trade battle, a battle of tariffs between China and the US, and how that plays out and the uncertainty it throws up. So unless something really serious happens globally, I don't see a very sharp correction in the Indian market. But the thing is, with all of these uncertainties, it's very hard to see it outperforming.
Okay. Neelkanth, given that you don't expect a sharp fall for Indian equities, I want to focus a bit on your model portfolio and some micro questions as well. You've been massively underweight on NBFCs, and you've very largely shifted from PSU banks to private banks in the model portfolio, barring for SBI. Take us through the rationale behind being underweight on NBFCs and not looking at anything beyond SBI and the PSU bank space.
So on NBFCs, the key concern is valuations, right? So I fully acknowledge that with the PSU banks becoming short of capital again and actually being very reluctant to lend, the prospects for growth for the NBFCs are quite strong, and therefore we are also quite constructive in our earnings forecasts on some of these companies. What I worry about is valuations, and for some of them, I think keeping growth at 30 to 40% a year is actually going to be very hard to do without meaningfully raising risks. And as some of these firms become larger, given that they're primarily wholesale funded, there is the risk of liquidity. The propensity to keep growing their book is something that leads to a lot of risk build-up. So that is our concern. Within NBFCs also, there are a few names that we published that we are overweight on. In fact, funnily enough, in the last 6 months, the sector that has given us most outperformance over benchmark in our model portfolio has been NBFCs, because we were long a name which did very well and short a name which did not do very well. So we are not slamming down the whole of the sector, but I think there are only a few names that we like. On PSU banks, I think the concern is, of course, the valuation gap with private banks has again widened to near record levels, and therefore there is a temptation that you bottom fish. But I don't see anything structural changing. The reason why we even added to weights on PSU banks in October was that there was at least growth capital coming in, and there was a prospect of sort of digging themselves out of a vicious cycle of falling capital and therefore falling incomes and stable costs, and therefore again bigger and bigger losses. But I don't see that cycle ending as of now, so we would stay away from that.
Neelkanth, Sakti Siva told us that you all are positive on IT and metals. Anything else that's attractive now, especially, I mean, construction, since we hear of so many road orders?
Yeah, so industrial is something that we are positive on, construction in particular. Construction is something that we have liked since, I would say, late 2016, when we shifted weights from consumer staples to some of the construction names, because order momentum, construction activity did pick up. I think there is quite a bit of good momentum in roads ordering that has happened in the last 2 months. We were worried till December, January that road ordering this year was running well below last year's levels. This year, now thankfully, last 2 months there's been a very meaningful catch-up. What we also think is that one of the largest industrial names that we have in the model portfolio, it's also bottom of execution, the ability to change some of the, and these are, and while on P multiples it doesn't look cheap, but these are cyclically depressed earnings, and at least selectively in some of the sectors capex is reviving, right? So steel, finally, it was unthinkable 2 years back, but there's already 10 million tons of new capacity announced. It is possible that in the next 1.5 years you see another 10-15 million tons of capacity announced, and it will be necessary for India. There is stuff, as you said, happening on roads. There is stuff that will be needed for airports. So I think in pockets, activity levels are starting to pick up. So this is early cycle. This is nowhere close to a phase where at one point we had 35 million tons of steel capacity under construction on a much smaller base. So the cycle will turn, but I think at this stage we would be over with that sector.
Neelkanth, last year you gave a very big call on IT, and that really has done well in the last 3-4 months. Any big call within the sectors that you like and which probably will outperform in 2018?
No, that's it. I mean, there's only so much of big sector changes that you can do. We remain overweight on IT. It has already outperformed. The valuation gap has narrowed, but we think there's another 10-15% increase that can happen from here.